Midland Wealth Management presents Market Insights.
Hi everyone, this is Dan Zeigler, Portfolio Manager at Midland Wealth Management. I wanted to provide everyone just a quick recap of the markets for the month of February. The equity markets were off to another great start in February until this last week as equity markets sold off sharply, mainly led by big technology names. In fact, the NASDAQ was down 4.9% just this last week alone. So what has led to this increased market volatility, especially as the economy continues to get closer to reopening later this year and more Americans are being vaccinated? First, long-term interest rates have risen sharply in 2021 so far. The yield on the 10-year Treasury has climbed from less than 1% at the beginning of the year to an intraday high of about 1.61% this last week. This is the highest level the 10-year Treasury has been in over a year. Yields are beginning to rise as we continue to see better news on the pandemic, encouraging economic data for the first quarter, and rising prospects for another fiscal stimulus plan in March. Bond investors are now beginning to worry all of this positive news will bode well for future economic growth and could lead to higher inflation down the road. This may cause the Federal Reserve to shift their policy sooner than expected, and they may have to start reducing their bond purchases or even raising rates sooner than expected. In the long run, higher interest rates are certainly a good sign as they are showing the economy continues to improve. However, the speed of the increase is causing some increased volatility, and we are seeing some stocks repriced to reflect a higher interest rate environment. Higher yields can be negative for highly valued equities as their valuations are more difficult to justify, which is the area we've seen the most volatility. The days of just buying any of the market leaders, regardless of their valuations, may be drawing to a close. Investors now must recognize there are other alternatives out there, including cyclical stocks that have underperformed, as well as slightly more attractive bond yields. Despite the increased volatility, the S&P 500 is still only 3% from an all-time high and still had a positive return of about 2.5% this month. Both value stocks and small cap stocks continue to be the big winner so far this year, with small cap stocks up close to 11% this year. All eyes will be on the jobs number this Friday. If the jobs number is better than expected, we could see yields continue to go higher and stocks may continue to readjust to a higher interest rate environment. Thanks for joining me today on this month's market recap.